The wealth creation study, I think some thoughts cross mind. What should be this 5-year rolling we have been doing. So let's look at what it would have been in 25 years. That is the longest data series you have in India, electronic data series about corporate performance and everything else. So we said, let's look at 25 years. That's a nice rounded sum of 25 years. So how does, which are the companies which were there? Because that's how, when we started our career 25 years back. So we have lived this entire 25 years. How does it feel to look little longer? People are tired of 6 months, 1 year, 2 years. I think 3 years is a very long term nowadays. But really, when you come to building businesses, investing in them, and prospering through businesses, it's not about 1 or 2 years, 3 years, 4 years. You can see your own businesses. How many years it has taken for you to build a small franchise of your own, and how long it is going to take. How long it will be that your businesses will become bigger. So, like Motilal Oswal is now 25 years old, and we feel very young, very, very young. So, I think in corporate history, in corporate longevity, 5-10 years is not a very long what you call profile, and with the new advent of management technologies, in terms of you can recruit the best of the talents all over the world to take care of your companies. Now, the companies are not dependent on what happens to the promoter. When the promoter starts, and if he lives for 50 years active life, the end of company doesn't come because of the end of the life of that particular person. Now he can recruit, like Walmart was started by Sam Walton, but he didn't give anything to any of his 4 sons, but gave it to the professional management. And that has longevited the corporation's life, and Walmart rules the world. So I think that fundamental change in the management style in last 20-30 years in America, and hence now in all over the world, that has changed the longevity of the corporations in the world. And hence a thoughtful investor can invest not only for next 3, 5, 10 years, but it can invest for much longer period. So, and there is no conflict between the short term and long term. So we said, let's look at how things have happened in 25 years. Because fundamental thing about buy right and sit tight is that you have to buy right fundamentally. If you don't buy right, in that case, sitting tight is one of the biggest curse. So you must get the buying right for making money through this particular slogan. So what is investing? Let me just, for a sec, let me remind you what is the definition of investing means. Investing is foregoing current consumption or purchasing power now in order to have, in order to be able to consume more in the future. So you are surrendering current purchasing power to get more purchasing power in the future. Earlier it was thought that laying out today's money to get more money in the future. But that was not, that was very simplistic, and it was not taking care of the corrosive influence of inflation. So when you look at the purchasing power, you are surrendering certain purchasing power today to get more purchasing power in next 5, 10, 15 years. So if you buy 100, if you give 100 rupees today, tomorrow if you get 105 rupees, but inflation is 10%, so you're not making money. You have to get more than 110 rupees to get some purchasing power gain. So what is happening is in fixed income market, people are gaining 8%, 7%, 7.5%, but actually inflation is 9.5%. And that too post-tax. Inflation is always post-tax. So people are not, by going to the fixed income, people are not gaining any purchasing power advantage. At best, they are able to kind of preserve the purchasing power. But I think most of the guys here, they are trying to help the investors or their clients gain more purchasing power. So how do you gain more purchasing power? So these are the, is it clear? Can you see this? But I think I'll just speak about it. It will take some time before slides start becoming meaningful here. If you have been to fixed income only, in last 34 years, the fixed income has gone 16 times. So, but rupee value has gone down from 100 to 6 rupees. So because of inflation, the decline in the value of rupee is almost 1/15th. So when you have your fixed income has gone from 100 to 1600, actually you have gained nothing. The 100 remains 100. Gold has gone from 100 to 4,000, so 40 times. Stocks have done about 21,000 to 211 times, whereas the cum dividend return of index is about 354 times. So this doesn't take care of any kind of outperformance, but just the index is more like 354 times. So if you look at the 25 years, exactly 25 years back, the index was 398. 400 was the Sensex number, which is today 21,000. So it is, including dividend, it's about 32,000. So one has become literally 50 times. Just the Sensex has become 50 times in these years, whereas the fixed income would be more like 12 to 13 times. So that's the kind of gap we are talking about. This is how the power of compounding works. I mean, as the growth rate and the longevity, when both they combine, people are focused onto the growth rates, but not the longevity of the growth rate. When this growth rates go to, say, more like 20, 25%, but the number of years it compounds is, instead of 5 years, 10 years, 15 years, and 20, 25 years. When you look at a 25-year line, at 25%, it becomes 265 times. At 30%, it goes to 706 times. And at 35%, it becomes 1,800 times. Now, it looks that I'm doing it only on the slides. But I will show you some of the companies which have achieved this. So this is the 25-year result. Can you read this? I mean, is it visible? So yeah, so I'll read it out for you. In 25 years back, ITC was the company which was available at 111 crores. For 111 crores, you could buy entire ITC, which is today, 31st March is 2,44,000 crores, and probably now it is more like 250,000 crores. So that's the kind of change which has happened in 25 years. And ITC was, 25 years back also, it was a monopoly tobacco company, and now also it's a monopoly tobacco company. Blue chipness of ITC has never been diminished. So this money is not made in last 1 year. This money is made in every single year from 1988 till now. It is 35% compounded. And on that 111 or whatever is the valuation, the total dividend in last 25 years is 23,000 crores. 23,000 crores is the total dividend. And 23,000 crores, the present value of those 23,000 crores, because dividends came in 88, 89, 90, 92, which you further reinvested. It could be about 60,000 crores at 15% compounded. So the amount of money which has this one company has made is quite staggering. I mean, this is the source of inspiration, because see, every company doesn't go through the ITC kind of phase, but if you become lucky, I mean, there must be a lot of investors here whose clients would have benefited out of this particular company. Next is Hero MotoCorp, second best company in last 25 years, Hero MotoCorp. These are the companies which were listed in 88. I mean, your Infosys, your TCS, Wipro, they came much later. Hero MotoCorp has done 31.6%. This company was available at 25 crores, 12.5 rupees price, 20 crores equity. So I know this company was available for 25 crores. On 31st March, it was 30,000 crores. Right now, as we talk, it is 40,000 crores market cap. The total dividend in last 25 is more like 9,500 crores. So these are the, very inspiring stories. Now cement company like Ambuja Cement. Ambuja Cement was just about formed right in front of me. Anil Singh and all were CFOs. This stock was 24 crores at that point of time. Now market cap is about 25,000 crores. And they have given about 4,000 crores dividend, 27.5% compounded. So the list goes on. Asian Paints, ACC, Bosch, the Myco, then Castrol India, Munjal Showa, Unilever, Nestle. I mean, if you see next 25 companies, you'll get to them. So look at ITC. ITC market cap 111 crores, now it is 244,000 crores, 36% compounded. It is multiplied by 2,400 times in 25 years. 100 times every year. That's the power of compounding and longevity. So, this is something which is, Infosys and all, they will also find it very tough to match. So this is the power of even old economy consumer monopoly. The only thing is the cigarette smokers, they don't have any choice but to give tax every day to this particular company. Hero Motocorp, multiplied by 600 times in 25 years. 1,600 times in 25 years. 32% compounded. So, I mean, I've been a significant beneficiary of this particular stock. I've been holding from 97 till date. I bought it, when I bought it, it was about 1,200 crores market cap, but this was only 25 crores market cap 10 years back. So between 87, 88 and 98, when I bought, it had already moved by 10 times. So, you know, this stock has been staggeringly performing for last 10 years. Sorry, last 15 years for me, and 25 years you have seen 1,600 times. Look at Ambuja Cement. Just a simple cement company, 1,280 times in 25 years. Asian Paints. Now you see the compounding rates have come down to 25. The moment you come to from 35 to 25, from 2,400, you come to 285 times. So this, it is mentally not possible to figure out what the compounding and longevity of compounding does. You know, another 5 years and another 5%. I mean, these two can be lethal at, in terms of what can be the portfolio performance. Hindustan Lever, which has been the, you know, kind of darling of every single investor who have come here, 211 times, despite brief, you know, underperformance in 2003 to 2008. So I think this company has given tremendous amount of dividend. I mean, total dividend given, I think in 2013 itself, you look at it, market cap has grown at 22.9%, PAT has grown at 20%, and dividend has grown from 39 crores only, 39 crores in 1988 to 4,000 crores now. I mean, dividend has grown at the rate of 23% compounded. I mean, these kind of investments, if you get even 5% allocated in your portfolio, I think 100% will be taken care of. So what are the characteristics of these companies? I mean, briefly we try to look at it. You know, one of the things is that these are all mass product companies. These are the companies, of course, with many more things, but they are fortunate at the bottom of the pyramid types. You know, I mean, a motorcycle, cheapest motorcycle company in the world, cheapest, you know, food company kind of thing, or very low grade, I mean, high quality, but economically priced, lowest cost producer in cement. So, you know, you'll find a lot of these fortunate bottom of the pyramid. Second, these products have not changed. Like cement has not changed for many years. Cigarettes have not changed. I think cigarette brands are same. I think I don't smoke, but I think Will's Filter or India Kings or whatever, they have not changed for the ages. And so I think these businesses are one of the special thing about this particular thing, all these companies, is that the rate of change is very low. I mean, for 20 years, 30 years, 40 years, the business remains, underlying business remains same. 9 out of 10 companies, 9 out of top 25 companies were leaders, clear leaders in their industries. So you'll find that most of these 9 out of 10, they are leaders in their respective category. Hardly 1 or 2 of them, they may not be the leaders, but I think one of the things important is that if the category survives, the leader definitely prospers. So it is, one must look for leader companies, and that's why markets are very smart in valuing the leader companies. Number 1 company will always be 20, 30, or at times even 100% at premium to the number 2 or number 3 companies. One other thing which is running across is the corporate governance and value system and ethics of the companies. These companies are ethical companies. These companies have demonstrated not only they have taken care of their employees, but they have taken care of their shareholders in terms of dividend payout, bonuses, and capital allocation, most importantly. And that's why these companies have been darling of the market at every point of time. Another thing we have seen is they are much more customer-facing, consumer-facing. I mean, you have the consumer businesses, you have industrial businesses. So you will find that 14, 15 companies out of 25 are clearly consumer businesses, whether it is Asian Paint, whether it is ITC, Unilever, Nestle, all these companies are consumer-facing companies. So because the discretionary consumption in India is going to explode, I mean, what we have seen in 25 years is not even the starting of the consumption in India. So in next 25 years, you will see further build-up of the consumption, whether it is automobile, whether it is FMCG, whether it is media, whether it is financial products, whole lot of this consumption will come through. So in that period, you'll see the buildup of newer businesses coming from consumption side. Because of good payout, good capital allocation, good corporate governance, you have wonderful return on equity from these particular companies. Except for one company, I think every company has consistently more than 15% return on equity in this particular category. And very few companies have even less than 20%. So clearly, profitability and sustenance of profitability is one of the things which you get to see. I mean, bad companies don't last. So when you buy good companies, you have to make sure that these are profit-making, cash-oozing machines. Rewarding the minority shareholders that I have told you, I mean, their bulk of them have payout ratios more than 25% and very strong growth engines. So quality you need quality, you need growth. Both of them you need across the categories. So these are the observations of last 25 years. So we said, let's look at the market, how they have behaved. I mean, because closer home, there are a lot of challenges in terms of equity investing. We know the customers are, our clients are not that aligned to investing in equity. So what is that which is keeping the people away? One of the things is the people don't look at, the recency effect is very high. So what has happened in very recent time is what you call clouding the minds of everybody. But if you look at the 34 years of stock market, 23 years have been a positive year, and only 12 years have been negative years. So 2 out of 3 years are positive year, and 1 year is negative. Out of that 12 negative years, 4 are big negative years. 1988, 93, 2001, and then very recently 2009. So what is happening is these markets are going from one boom to other boom. Every 7 years there is a boom bust cycle. So 85 boom got busted in 88, 92 boom got busted in 93, 2000 boom, Y2K boom got busted in 2001, and 2007 Lehman Brothers global credit boom got busted in 2008. So because of that, you have a 35-40% decline in the market. But the good thing is that before the bust, markets have risen by 300 to 600%. It has the big burst in the market, which is always the fear in the mind of the investors, has never happened unless the market has risen big time. So right now, markets have corrected. Markets are not in the mood of optimistic, great optimistic mood. So my sense is that you can correct the market by 10% anytime, but I don't see how it can be a crash kind of situation in near future, because markets don't have that kind of frothy levels. So our investing style is, the process is laid out very clearly, and it's very simple process, and that's why we can talk about it in a very in few minutes. What we call our investment philosophy is QGL: quality, growth, and longevity. When we look for 3 qualities in any stock or any company we put. Quality is quality of business and management. Growth is sustained growth for long term, and longevity of that growth is also longevity of quality and longevity of growth. So when the quality, growth, longevity, when all 3 comes together, valuation becomes, of course, very important, but you don't get these kind of companies very cheap prices. So we would like to load the portfolios with highly growth-oriented, highest quality companies, even if it is priced a little higher than very cheap prices. So they are not the cheapest companies, but reasonably priced companies with QGL kind of a quality. It's a buy and hold approach, and focus 15 to 17 stocks. Because there are not many stocks like this in the industry itself, in the market, and we also have very few stocks which we understand. So clearly, buy and hold and focus into 15 plus minus 2 stocks. That's the kind of approach we have. And so how do we pick up the stock? I mean, what exactly is the steps we go through? A business we understand very clearly. 95-97% of the job is a business we understand, favorable long-term economics, able and trustworthy management. We have got a lot of competent management, but competent and honest management, and buy at a margin of safety or whatever little reasonable price you can get. So this is very clearly laid out stock selection process. And buy and hold, just to support that, this is the latest slide on Nifty survivors. If you see, the index has done about 13.5%, but the companies which stayed for 3 years have done 9%, 5 years 9.6%, 7 years 12%, and 10 to 17 years, 19%. But the stocks which always remain, there are 13 or 14 stocks which remain always in the Nifty, they have done about 21%. So buy and hold, the companies which survive and remain in the index for long term, they do very well. So that's very clear that buy and hold has meaning even in a passive thing called Nifty. So just to conclude, the whole idea of our investment process and effort here is to make money. See, there are two ways you can make money. One in the bazaar and other you can make is in businesses. So, what happens in Infosys Bangalore is one thing, and what happens in Mumbai Stock Exchange is yet another. We don't try to make too much of money in Mumbai. We try to see that companies make a lot of money in Bangalore in their real businesses. And we focus on those kind of companies, and rest all, whatever happens in the market, that's we've got to turn lucky also at times, but the focus is, 99% focus is on the understanding the business, longevity, growth, quality, and everything. And that's what we talked about. We are not that, that's why we don't run a cash and stock kind of situation. We don't time the market. We are always 100% invested.